Hello, this is Dr. Sandeep Salunke, and in this video I am going to discuss with you about unit number 3 ratio analysis, which is in management accounting prescribed by Rani Chennamma University Belgavi for BCom 5th semester. So this is my second video on ratio analysis. So if you have not gone through my first video, please go through it where I have explained theoretical aspects of ratio. At the end of this session, you are able to know meaning and formula of liquidity ratios, that is current ratio and liquid ratio, and also how to calculate current ratio and liquid ratio. Liquidity ratio. What is liquidity ratios? These ratios plays a key role in the analysis of short-term financial position of a firm. Liquidity ratios are used to analyze short-term financial position of a firm. And there are two important liquidity ratios are there: current ratio and quick ratio. So, what is current ratio? Current ratio means the ratio of current assets to current liabilities. So in simple words, what we can say, current ratio establishes relationship between current assets and current liabilities. Formula for calculation of current ratio is current assets divided by current liabilities. So which are current assets? Those assets which can be easily converted into cash within a short period of time, say 1 year. Current liabilities. Those liabilities which are payable within a short period of time, say a year. And standard current ratio is 2:1. So 2:1 means what? 2 is current assets and 1 is current liabilities. Current assets should be 2 times than current liabilities. Suppose, take for example, in a company, if current liabilities are of rupees 1 lakh, then current assets should be of rupees 2 lakh. Okay, so this means current assets should be 2 times than current liabilities. Components of current assets and liabilities, as you know, this is very simple thing as you have studied. Current assets includes cash in hand, cash at bank, stock, bills receivable, advance given, prepaid expenses, debtors, outstanding incomes, etc. And current liabilities includes creditors, bills payable, bank overdraft, cash credit, loan, short-term loans, outstanding expenses, dividend payable. So these are components of current assets and current liabilities. Next, liquid ratio or acid test ratio or quick ratio. So what is a liquid ratio? So liquid ratio is the ratio which establishes a relationship between liquid assets to liquid liabilities. Now formula of liquid ratio. Liquid ratio is equal to liquid assets divided by liquid liabilities. But in some books they have used the formula liquid assets divided by current liabilities, and some authors prefer instead of current liabilities they have used liquid liabilities. So what is liquid assets? The meaning is very simple one. All current assets except two. One is stock and one is prepaid expenses. So liquid assets means all current assets. We have to just ignore two. One is stock and another one is prepaid expenses. So what is liquid liabilities? Here also the same case. It includes all current liabilities except two things: bank overdraft and cash credit facilities. Now standard liquid ratio is 1:1. So 1:1 in the sense liquid assets and liquid liabilities should be equal one, that is 1 is to 1. Now let's take one problem on it. Cash in hand is 10,000, sundry debtors is 70,000, stock is 50,000, prepaid expenses 10,000, sundry creditors 40,000, bank overdraft 20,000, outstanding expenses 10,000. Now with this information, calculate current ratio and liquid ratio. Now calculation of current ratio. What is the formula for calculation of current ratio? Current assets divided by current liabilities. So in the problem, which are the current assets? Cash in hand 10,000, sundry debtors 70,000, stock 50,000, prepaid expenses 10,000. So it comes to 1,40,000. Now current liabilities. Which are the current liabilities which are given in the problem? Sundry creditors 40,000, bank overdraft 20,000, outstanding expenses 10,000. So it is 70,000. So 1,40,000 divided by 70,000, it comes to 2 is to 1. Liquid ratio. So what is the formula of liquid ratio? Liquid assets divided by liquid liabilities. So liquid assets, what I told you, all current assets except two. One is stock and another one is prepaid expenses. So here liquid assets includes only two things, cash in hand and sundry debtors. So it is 80,000. Liquid liabilities. So here also all current liabilities except two. One is bank overdraft and second one is cash credit facilities. So in the problem, bank overdraft is given, so we have to exclude it. So liquid liabilities are 50,000. So liquid ratio is equal to 80,000 divided by 50,000. So it comes to 1.6 is to 1. What is standard? 1 is to 1. But here it is 1.6 is to 1. So for preparation of notes, I have used these books. Thank you.